Hello, good morning, good afternoon, or good evening, depending on where you're joining from today. Thank you for joining our weekly live stream. This is a live discussion we have every Tuesday to talk about all things related to technology and digital transformation. My name is Eric Kimberling. I'm the CEO of Third Stage Consulting. We're an independent consulting firm that helps clients through their digital transformation journeys, beginning with digital strategy and software evaluation all the way through implementation planning and including implementation, PMO support, change management, process improvement, and architecture. So feel free to reach out if you'd like to learn more about what we do, but excited to be with you here today. We do this weekly live stream every Tuesday, same time, same place. We're streaming to LinkedIn, YouTube, Facebook, and X. So wherever you're joining from today, thank you. We're going to introduce our guest here in just a moment, but today's topic is tech startups and M&A, mergers and acquisitions in the technology space. So this is a kind of a new topic, something we haven't covered before in this podcast. I'm really excited for the topic and for our guest here today. I'll introduce him in just a moment, but if you have questions along the way, I encourage you to please drop those questions in the chat as we go. We're keeping an eye on the chat here, and I'll pull up some of the questions that you all have here as we go through the conversation. And speaking of the chat, if you don't mind just dropping the chat where in the world you're joining from today. We tend to draw people from all over the world. Love to hear what city and country you're joining from here today. So thanks for joining. Again, my name is Eric Kimberling. We're here to talk about tech startups and M&A in the tech space. And joining me to help unpack this conversation is someone I've known for over a decade now, Adam Haynes from GLC Advisors. Adam, thanks for being here today.
Thanks for having me. Good to see you.
Yeah, good to see you too. And I guess for those that don't know you, I've known you for over a decade. We go back, and we've been in touch over the years, and I know a lot about you and about your company. But for those that don't know you, tell us a little bit about you and your background.
Sure. So I spent a decent part of my formative years in the Bay Area. So I was born in San Jose, and then moved back for high school. And technology was really taken off. Kind of mid 80s to mid 90s. That was really a big, interesting, the personal computer. And so I really fell in love with technology at that point. I'm a tech banker, have been a tech banker for 30 years. After business school, worked in New York, worked in Minneapolis, worked in Boston, founded a firm here with other partners in Denver as a middle market M&A boutique. And that's what we do at GLC Advisors, which is where I work right now, which is a financial advisory firm based in New York, offices in San Francisco, Los Angeles, and Denver. And we do middle market deals. We advise, me personally, technology deals between, call it 20 and 250 million in enterprise value.
Great. How did you get into this space? I mean, what led you? It sounds like you went to business school. Did you have a grand plan to do this early on, or how did you end up here?
I did. I like the transactional nature of what I do. I like the relationship nature of what I do. So I like people. I wanted to be near tech, but I knew with just who my personality is, that just working for a tech company, I worked for Sun Microsystems, for example, one summer. And just the day in, day out wasn't really thrilling me versus being an investment banker, mergers and acquisitions. It's different set of skills. You're always meeting new people. When you do it in tech, you're always at the forefront of innovation, and that still fascinates you. So, and I love M&A. I love the legal parts of it. I love the analytical part. I love the negotiating part. So I love what I do.
Yeah, sounds like you landed in a good spot and are creating a pretty cool company that advises companies on this. But when you're looking at a startup, whether it's a tech, because you deal with tech like software companies and services, right? So you deal
Correct.
with both. And is it mostly enterprise technologies and enterprise technology services?
Yeah, and B2B applications. So yeah, no B2C, no apps, that sort of thing. It's true basic software, automation, business process management, running things efficiently through code.
Yeah. And you tend to, if I remember correctly, look for underserved niches or niches of technology that maybe are not being well captured in the market, or is that true?
Yeah, I think they're interesting, and we're not investors, but from the sell side, mergers and acquisition, you want companies where there will be an interest. And so those companies that will draw investor or acquisition interest serve verticals and customers that need what they do, right? So we loved GovTech, for example, starting probably 8 years ago. There was a big investment cycle, probably 15 to 20 years prior to that. And so there was a big transformation of new people coming in, people retiring, the new people coming in expecting that consumerization of Apple, Amazon, feel from a business app, and a big transformation as a result of investment and new startups and GovTech businesses that weren't 30 years old. So that's a great example. Supply chain's another great example. And vertical SaaS businesses, quite frankly, people that really, it's code and it's technology, but you're also solving a pain point because maybe you were in that industry. You've been in that industry for 15 or 20 years. You know the nuanced pain points, and you're solving a problem for those people.
Right. So if we had to summarize what you do, I mean, you're looking for, you essentially match buyers and sellers, right? I mean, you're
right.
trying to find the best buyer for a seller.
That's right. And often in the last 15 plus years, that buyer is private equity who's done some sort of a recap of some sort, a majority recap. The business owner takes money off the table, but then rolls a big chunk into the new business with private equity as a partner. That's been a very big trend over the last 15 to 20 years.
Gotcha. Okay. Very cool. It's very, very interesting business and so different from what I do. So I'm always fascinated by your guys' your business model and just what you do in general. But when you're looking at a tech company, whether it's a startup or it's high growth or it's been around for a long time, whatever it is, when you're looking at this startup or this potential seller, or someone looking for an investor, what makes these companies attractive from both an investor standpoint, but also from I also want to look at it from a CIO perspective or a tech buyer's perspective. If they're looking at a potential technology or a services firm, what are some of the criteria they should be looking at either as a buyer or potential investor in the company and or as a potential customer?
Mm-hmm. Mm-hmm. Yeah, I mean, I think that not to take the romanticism out of it, but it all comes down to financials, right? I mean, if you are solving a problem and it's a really important problem and your customers want you to solve that problem for you and they will continue to pay you, this is for a software company, because they are getting that value, they might even continue to buy from you. What you're doing, the mission criticalness of what you're doing, will drive the value of your business, and it's reflected in your financials, right? I mean, it's the difference between a 10 million ARR with 500,000 in EBITDA and 10 million in ARR with 3.5 or 4 in EBITDA, right? There's a difference there because there's a price point. People are willing to pay up for something that you're fixing for them, versus maybe people don't value it as much, and it shows in revenue growth, or it shows in pricing power or lack thereof, and therefore maybe a reduced or diminished EBITDA margin. So I hate to just bottom line it with financials, but we're big fans of. So there was a company called 3PL Central in Manhattan Beach, and that founder worked in the 3PL world, so warehousing other people's products and delivering and that sort of thing. Right. And that founder grew up in that business and decided there's a better way. The technology that's available to me now could be improved this way, this way, this way. Why doesn't this talk to this? Why, that kind of vertical know-how. And the value of that company, I think, is that he solved those pain problems with technology, right? So that's a big value driver. Are people downselling you, killing seats? Is it a nice to have versus a must have? The software that, and we certainly saw it in that slight blip during COVID, but then, as technology valuations came down with interest rates going up, we saw people turning things off, or people keeping status quo. And that was a direct reflection of how mission critical are you to the business operations of the customers.
Right. Right. Are you seeing a lot with AI? I mean, are you investing either in standalone AI services and tech companies and or other providers that are heavily invested in AI?
At this point in the middle market, right, most of our B2B application software companies are using AI just to improve what they have, versus brand new startup, we're on AI only, we're going to help AI people, or that. So we're less in the cutting edge, the people selling, I guess, the hammers and the things like that, the infrastructure for AI, and more, we're asking all of our clients, how are you using it? What is it doing? How is it fixing things? How is it speeding things along? And the people that are using it efficiently for little pieces, right? Little, like maybe it would replace an API for an integration. Just you're talking to AI and having that connection happen. So little pieces, but not wholehearted code, at least not yet, in our clients.
Right. Right. Gotcha. I want to get to a couple audience comments and questions here. We have, I'll just call her Teeny, or he or she. Teeny on YouTube says hello. Maria from LinkedIn, thanks for being here. Maria says, a great day, always informative content. Dennis from Cochin, thanks for being here today. And someone joining from Brazil, I can't see the name there, but someone joining from Brazil, and someone who wants us to take our shirts off, which is super strange. I haven't had that one before. I know we're two good-looking guys here, but everyone relax. We're here to talk about technology, not take our shirts off. And then there's another comment here. I've been doing managed services with my old copier dealership, but am thinking of switching it up. So thanks for your comments here, and hopefully we can give you some info of value here. I'm curious to hear from those of you watching, though, what kinds of, what are you interested in terms of tech, M&A, and that sort of thing. I'd love to hear just sort of your questions, and any questions you've got for Adam, please drop them in the chat, and I'll be pulling those up as well, in addition to mine. But just to get through here to some of these additional things you're seeing in the market, what are some of the key signals that you look for when you're looking at or assessing a company? What are the key signals that they're ready for some sort of either acquisition or big investment? What do they need to be ready?
Mm-hmm, mm-hmm. So I guess there are a number of criteria to do that. The first is just, well, what is the goal of whatever activity it is? Are you raising capital? Are you raising seed? Are you raising an A, a B? Are you doing a recap? Are you selling the company? So that's number one. What are you trying to do? We would always say, you've got a great product or a company that you've built, you're going out to market, you want as many people to look at it as possible, right? And so just because it's a funnel, the more people you talk to, hopefully you have alternatives at the end of your process, so that you can make and high valuation. So I think that's super important in terms of size, so that you can get enough people paying attention. So, a $2 million ARR versus a 12, there's going to be a bigger buyer set for the bigger company.
Right.
And that probably spills into number two at 10 or 12 in ARR versus 2. You probably have a really good idea of the profitability picture, just because you've scaled to a certain point where you should, yes, you're investing heavily in sales and marketing and you're growing, but you should have an idea of kind of run rate EBITDA margin potential there, versus the 2 million. It might be a little more difficult to ascertain. So profitability, that critical, mission critical piece, you want to make sure that what I'm providing people is really important, because there are no dumb investors, there are no dumb buyers, right? If you're having a real hard time describing and conveying the value of your product to people and they're not buying it, an investor is going to figure that out, right? So
right.
But I think that's, and then again, what is your ultimate goal? Some people want to take in capital because they have actual needs for capital, R&D, sales and marketing. Some people take in capital because the capital comes with human capital in terms of board members and access to operating partners. And, I'm talking about institutions that would invest. because it can be lonely at the top, right? Building your business, as you know. It can be lonely without that sounding board. So some people like having professional investors who have seen a lot of businesses, seen a lot of business models, add that institutional knowledge to them. That's the access to something they wouldn't have before. So other people want to expand internationally, or want access to capital to grow faster. But again, you would know, and the entrepreneur always knows, right, when the time is right. I think, that just from a gut feel, not meaning, oh, there's dark clouds on the horizon, because
Right.
again, there's no dumb investors or buyers. They're going to see the dark clouds too. But that kind of, hey, I've taken it really far, and we've been successful. I think we have something here, but you want to take it to the next stage. And maybe you recognize some limitations, right, of you and your team, and therefore a transaction, recap or a capital raise or a full sale changes things up.
Right. Yeah. Yeah. And I think a lot of times people think of it as just, I've got this startup, I've got this high growth company, I want access to money, which obviously is an important consideration. But you had a really good point, which is when you have a more professionally, when you have professional investors that are pretty cut and dry, I would imagine, in terms of either you're delivering the ROI they expect or you're not, it gives you a certain amount of sophistication, I would imagine, access to the sounding boards and the professionalism and that sort of thing that goes along with private equity or professional investors.
Right. Yeah, and I think don't quote me on that. Well, here I am on a podcast. I think
You are being quoted.
Vista Equity created kind of that playbook where if you work for one of their portfolio companies in HR, you tabbed HR, and here are the systems we use. Here's the meeting frequency. Here's how we hire. Here's how we fire. It's all codified and professionalized for you. And that way, all of your portfolio companies are doing the same thing, and they can talk to each other and problem solve with each other. And I think it was Vista that pioneered that, but it's not for everybody, right? You have guardrails and you can't go outside. But boy, it's an efficient way to run a business, and as private equity, to invest a bunch of businesses, knowing you're using NetSuite because of this, and you're on, what have you. It just makes a lot of sense from a investor standpoint.
Yeah. That's super interesting. A couple of audience questions here or in comments. Duran on LinkedIn is joining from the Bahamas. Thanks for joining here today. Van on YouTube joining from, looks like the UK. Is that a UK flag? I should know this. I apologize to those that are that I think that's a UK flag, but I'm not familiar with. Anyway, you tell me what country.
That's Australia.
Oh, is it Australia? Yeah, I can't read.
So.
Okay, well, if we're wrong, clearly I was wrong, but if we're still wrong, let me know. And then here's an interesting question from Brend on LinkedIn. And Brend says, what are some of the challenges or pitfalls when it comes to M&A with the aim of expanding into a new territory or trying to establish a foothold in a new growth market? Do you have any thoughts there?
Yeah, I do. I mean, there are pitfalls with M&A in general, but specifically here, trying to get into, it looks like, geography. I'm not sure you would buy a product company buying a product in another geography. I'm not sure I see that too much unless somebody's buying in Australia to establish that beachhead. The difficulty with it is it's two different organizations, right? So this is more broadly with M&A. It's two different cultures, it's financials, it's technical, it's how do we do things, it's how do we praise our successes, how do we deal with our underperformers, all of that is so idiosyncratic to those two companies that you have your way in Denver, Colorado of doing things. And if you want to expand into Sydney, things are different there beyond just the geographies, right? So I would take a step back and just say what's really important in any M&A to make that work, whether it's for new products or new talent or geographies or is that integration piece, right? And making really sure. We sold a company, this is a long time ago, I'm sorry, to EMC when it was still on its own. So, but they started their integration literally 30 to 45 days before close. And they did it with armies of people. And they primarily initially focused on HR and focused on the people, right? So day one at close, we can't have people worried about benefits and healthcare and reporting responsibilities and roles and org charts and sales comp and right, that kind of stuff, because whatever impacts the people it is the value of what you're buying, right? Especially in a tech company, whether it's services or software. So making that as seamless as possible to make sure that, there's a pregnant woman at the company we're buying who's due next month. Well, we need to make sure there's not disruption in her healthcare provider. And it's that kind of thing to make sure that not only is it the right thing to do, but it also ensures a pretty smooth transition for those first few months when things are different. And change is difficult, right, for everybody. And there will be change, but I think how you handle that integration and the people and reporting, right? Maybe you have two different sales forces. Maybe that Australian company also had people in the US because it was trying to expand. And now you've got some conflict with people calling on the same customers. And boy, addressing that as you are getting to close, if possible, makes all the sense in the world. Otherwise, you close and then it's this cold start of, well, we need to figure this out. And people begin to point fingers at people. Why did we do this? M&A is terrible. It just doesn't have to be that way. So I don't know if that answered your that question, but that's just generally how the pitfalls in M&A.
Yeah, regardless of,
I guess really quickly on technology too, really doing your work on what you're buying and really understand. If it's big enough, you probably have an outsourced, like a Cross-Lake technology or somebody doing, or somebody like you doing some tech diligence. But if it's not, and you're doing it yourself or your team, that adage that I love is plan the work and work the plan, right? And from that, I mean, here's what this product does. We need to assess this. This piece of code was written 7 years ago. We need to assess that and really plan it all out, and roles and responsibilities and communication among your team to make sure that through all your efforts, whether it's code reviews or a lot of interviews, you're kind of checking that box and getting to know everybody has technical debt, but you really ought to know with a pretty strong amount of certainty within 3 months of close what has to be done here, right? What needs to be rectified? What's on the project list? Otherwise, that's a huge problem of what you've bought, right? The other issue on integration and M&A for services companies, especially for services companies, is that culture, right? We used to often think that if you could put 2 or 3 smaller services companies together to make a big one, you'd have, back to what I said earlier, you'd have more interested parties, right? You're a bigger company, right? So if you're each 5 revenue, 1 EBITDA, well, you're more attractive at 15 and 3 or 4 as a group, but you can't just combine those services cultures, as you know really well.
Yeah.
I mean, there's a esprit de corps that you have built that if you try to bring somebody else in, it's different. It's change, right? I mean, you probably have more to say about that than I do.
Yeah, and not only have we looked to potentially do that at third stage, we've looked at acquisitions, and we've been working with you about, kind of what our growth path forward looks like. But a lot of the consulting we do are larger organizations that have grown through mergers and acquisitions, and the culture piece is such a big barrier and pitfall for a lot of organizations. And that sort of leads to this really interesting question that I'm sure you've never seen this, but I'm going to ask you anyway. It's from Darian on LinkedIn, and I'm being facetious here. I imagine you have seen this, but Darian on LinkedIn asks, have you seen situations where a founder took capital for the right reason, but ended up with the wrong partner? Whether it's cultural difference or just some other difference that didn't make sense.
Yeah. I mean, for sure. Right. And a big piece of how we see our job as financial advisors and M&A professionals is to provide alternatives. But, you go through this big process of marketing and talking to people and running your process. And a big piece of that is meeting a lot of these people. So you've boiled the ocean, you've come down to 8 to 10 parties to spend a couple of weeks with, to maybe have dinner, or at a minimum have a 4 or 5 hour management presentation where you're talking to these investors and getting to understand what they think about what you've built, but also how, if they were your investor, how would the future go? Where would they put their money? Where do they see the value? How are we going to do this together? So part of our job is to force that socialization, and have our clients better understand each investor and what they think. The difficulty is everybody's on their best behavior during these. So nobody's going to show ugliness, and there is ugliness, right?
Right.
One of the questions we suggest our clients use with private equity in particular is, I'd love to talk to a number of your current portfolio company CEOs. One of the questions they're going to ask is, how is this board member when things don't go well, right? Hey, we missed this, or this hire didn't come, or, some sort of bad news. Are they problem solving, or are they finger pointing, right? And so that's, but I have seen it, back to the question, where, hey, we're doing this for the right reason. And oftentimes that is, I want to do a recap. I want to put some money in the bank to just protect my retirement, my kids, and operate a bit more loosely. I want that partner to help grow this business. I'm going to roll 20% into it, and we think this is great. But sometimes those partners change. Sometimes those that board, or that director that was on your board that led your deal, might get pulled away on something else, and you get somebody else on your deal, and but it's change. And yes, things can happen. There can be, generally, as you're meeting these partners, you're very candid about, here's the growth, this is the opportunity, this is what we're doing. So most people understand that. But even post-close, there's still some changes that they've been thinking of that they want to run by you. And if they own the majority of the business, those changes are happening. And you just have to trust that they're well vetted and analyzed, and they're not just whim or ego driven. They want to build value, obviously. So, but that involves change to what you've built.
Right. Yeah. Yeah, exactly. So what, you've kind of alluded to this a little bit, or we've touched on it a little bit, but what are some of the common challenges, or the most common challenges you've seen during post-acquisition integration? I know a lot of what you're doing is obviously pre-acquisition. You're leading companies to an acquisition or an investment, but when that investment happens, and then you've got the buyer in place, or it's a merger and you've got the combined entity in place, what are some of the common pitfalls you see in those situations?
I really easy. It's just change, right? So change is different. It's depending on, were you a founder, owner, operator doing your own thing, and then you did a recap with private equity? Because a lot of that transformation is accountability, and now I have a board, and now people are asking for things that I'm having to spend my time to produce rather than build the business, which is what I was doing as a founder owner. So there can be frustration there. There can be, I mean, this is a cold capitalist thing to say, but there can be in some businesses, people or favored people who maybe underperform, but everybody likes them and they stay, and, they do a pretty good job. But, somebody who's invested in that business doesn't necessarily have the patience for, oh yeah, they're late again, but that's what happens. Or, oh yeah, they said this deal would close, but it got pushed. And, typically that kind of, where you just let that happen. There's accountability now, right? There are quarterly board meetings with people who aren't terrible people, but they want to know more about the business, and they want to understand why we're doing certain things, and performance, and new hires, and new products, and capital expenditures. And, they ask questions, and you didn't used to have that when you were running it by yourself.
Yeah, absolutely.
And there are changes. It's interesting, and I don't think this is ugly, but a lot of times what we see is private equity tinkering with pricing models. How are you pricing? I also think, as a business owner, you're a little reticent to push through COLAs, even if you can, and just raise prices throughout. I think a lot of business owners just kind of keep it steady Eddie, and which is fine. But when you get that new outside perspective with a recap with a private equity shop, oftentimes their price increases. Maybe there's price and support, or product and support mixes and goal, better, best type pricing, and tinkering with that kind of thing to really improve the business. That's something you may not have considered as a business owner,
Right.
or thought possible. And so that's good value. But yeah, the pitfalls are, it's cultural, it's change for people. Everybody wants a good exit, right? I mean, I had we had a client in Augusta, Georgia, and he wanted to sell his business, and give the keys to a strategic. 100%, I'm out. And we ran that process. So go out to a couple hundred people, run the full process. And at the end of the day, he went the private equity recap route because he liked the people. He could see that they were super intelligent and really understood the industry that he competed in, and could be value add. And he wasn't totally ready to quit. And he learned that through the process. And so he did the recap and rolled probably 20 or 25%, and was the CEO for that next iteration for like 9 months.
Right.
Because he and the private equity group came to each other and said, hey, we need more out of you. We understand why you don't, you're independently wealthy over here. We just made you independently wealthy with the recap. But don't you think so you're the CEO and founder, but you're also an investor in this business. So with your investor hat on, don't you want somebody in the CEO seat with this new energy and this drive, and maybe has options, and they're hungry and they want to grow? And Joe, to his credit, said, absolutely. Right. So I'll step back. I'll be an executive chairman. I'll be, advisor. I'm available. But yeah, that 20-25% that I rolled, I want to make 3 or 4 times my money on it. And that's often what happens. Right. But he had the I don't know what the humility, I guess, to recognize, hey, I get it. I see what you're doing. I see what you're doing and I hate it because it's wrong. But I see what you're doing, and yeah, it makes a lot of sense, but I don't have it in me to be your guy. So let's get somebody in there.
Yeah. Really interesting. Here's an interesting question, and we'll see if you can answer this, Adam. I think this is a really interesting question. This is from Duran on LinkedIn. Duran says, how would you structure SaaS product expansion into multiple countries and break into those markets with the ultimate goal of an exit? Would it make sense to create offices that are directly managed in each country, or utilize integration or white label partners to remit license fees to us? Do you have a preference there as far as like what would increase the valuation or be most attractive to a potential buyer or investor?
Create offices that are directly managed. Wow.
So
yeah. And that starts to dip more into operations.
Yeah.
Frankly.
I guess the question, can I rephrase the question? How about this? If I've got a software company and I know, like, for example, Western Europe, I know that Western Europe, I think there's going to be a lot of demand there. Would it be more appealing to you as a broker, or someone who's finding a potential investor? Would it be more appealing to you to see us open new offices that might increase our fixed cost? Or would it be more appropriate to have partners that maybe are lower risk, but you don't control it as much, but you're taking a cut of what they sell? Or I'm just thinking out loud here, but I don't know if you have a strong knee-jerk reaction of what investors or potential buyers might be most attracted by, or would they say, just leave it alone, just stay domestic, and then we'll invest in you, and then we'll help you expand?
It's the latter, right? I would think. I mean, I'm just trying to think. So we sold a travel tech company a couple of years ago, and the way they expanded into Europe, really Western Europe, was I think he had worked with our company and then moved over there and wanted, on the sales front, to be able to gin up some deals and be the representative there. And that worked pretty well. But when we sold the business, the new buyer bought out that salesperson and shut that down, because I think their thinking was, we don't want the one person just kind of knocking on doors and kicking things around over here. If we're going to be there, let's be there. right, in a demonstrable way with an office and people, and let's actually be there. So I know they changed that. I've seen, gosh, we sold a services company a long time ago. He was big in London, but again, it was people who he knew and trusted to move over there, and they knew the culture, and they know here's what we push, and this is how the value we deliver. And so it was less about that partner. I mean, you probably have a better sense about partnership in EMEA, or right, expansion through that way, right?
Yeah. Yeah, like for us, we've done it both ways. I mean, in Asia Pacific, we have a local partner that has equity in the entity, and but it's someone that's pretty tightly affiliated with us. We own a majority stake, but we have someone who's an equity partner that's based in Asia Pacific. But for EMEA, for Europe, Middle East, and Africa, we have someone that's on our payroll. That we've hired to kind of open up that office. So we have both models. Honestly, the jury's still out. The verdict is still out on which one is going to be the better model. But we've tried them both for sure.
Yeah. Well, and it's back to when you laid out, is it this or this? It really is, from an investor's standpoint. I think they would rather see you totally, just because we're in the States, North America focused, and let them help you go somewhere else, because chances are there's a lot in North America that's untapped growth wise,
right?
An addressable market, and obtainable addressable market. So rather than somebody who's in North America who also has an office in Toronto, and there are these little bits, because then that investor probably has to decide, okay, are we really going heavy into these other areas, or can we really just go, gangbusters in North America?
Right.
I think it's a little more difficult, unless you're really big. I guess that's the other thing. See, my lens is the lower middle market. So a lot of founder, owner, operators who grow to 10 million in ARR have never thought, oh, I should be in Chile. I should be in Australia. Right. So I imagine if you are a couple 100 million in ARR, you bet you are starting to expand. That's probably just beyond my pay grade, unfortunately.
Right. Yeah. That's really interesting. Is the economy, particularly here in the US, or even just globally, when you look at rising interest rates, or interest rates there is, hit higher than they had been in recent years? You've got interest rates, geopolitical stuff, tariffs, trade wars, any of that stuff affecting the M&A market right now? Or what are you seeing in the overall, kind of investor appetite for putting their money somewhere right now?
Oh yeah, right now is unprecedented. So the easier explanation is, when interest rates were cut, things were crazy in 2021, 22, because the economy was so crazy and there was so much capital, and people were upgrading software and investing in new point of sale and doing this and automating this, and then when rates started to come up, that really slowed down. It slowed down the economy, and people started to kind of make do with what they had. So the capital expansion, and that really slowed down, and so the M&A markets were no different in tech, right? Crazy for a bit, and then just the worst we've seen for a couple of years now. This year, so that's that chapter. This year is just, it's on a daily basis, right? You don't know what's happening, so we're all trying to live with uncertainty, and try to see if we can go back to doing deals, which I think we can, even in this really uncertain world, right? I mean, and so the classic example, so we sold a dealer management software company, so that's to auto dealers. If we had that client today, and the tariffs may impact automakers, may not, we're not quite sure. Are we going to fix that? Is it 90-day moratorium? There's that uncertainty. And so if my software client needs growth and expansion among their clients, customers, but their customers are kind of hiding, right, waiting to see what's happening, and certainly not making big capital, investment decisions, then that can slow things down, right? So I think the tariff thing is disruptive, and it is slowing things down. But I also think we've been through the first quarter now, and now we're into April with the crazy tariffs going on, and people are realizing, okay, the status quo is going to be uncertainty. And if we're touched by some of this tariff thing, then we'll make that decision. But if we're not going to use the tariffs as an excuse not to go run a process. If our business is good and it's growing, meaning it's growing because our end customers seem to still be buying from us, and our pipeline is growing and our profitability is good, well, you should go do a deal. Right now in the tech M&A markets, it's that barbell distribution. So the A+ companies are getting the double-digit ARR type multiples. And then the guys at the other end are really busy, but getting kind of the 2018, 2019 multiples. And there aren't a lot in between. So the B+ businesses, and this goes for the last couple of years. So I do think that more of those B+, A- businesses are starting to go, because we've all waited for 2.5 years, right? They started to raise in the summer of 22. And that's really when the brakes hit. And 23 was super quiet, and 24 was super quiet until the end when rates started to be cut. And now we've run into this new wall. So, but again, back to that mission criticalness of your solution. If it is, so again, back to GovTech. GovTech seems to be one of those areas that's still doing pretty well, because there is that reinvestment phase going on right now. And there are a lot of interesting companies with new technologies that are replacing old monolithic, terrible systems. So GovTech, there's still investment there. And there are areas, supply chain, there's still a lot of activity in supply chain and improving logistics and things like that.
Yeah. And I imagine with trade wars and geopolitical stuff happening throughout the world, that supply chain management software is going to be in high demand for years to come. I would suspect as these disruptions happen or continue in global supply chains, it just means that there's more opportunity for automation and technology to help solve the problems, I would imagine.
Yeah. That's, and the other one last piece here, the bright spot since the Great Resignation has been services. Services broadly defined: business services, janitorial services, HVAC, GCs, plumbers, healthcare services, tech-enabled business services, IT consulting. And I think we might be in that period where people, if something is a little broken and underperforming software-wise, maybe we're not pulling it out and replacing it with a new product, but maybe we're getting services people to come in and do what we're trying to do, right? It's kind of that new coat of paint feel, where I think people can come in and say, okay, you want this to talk to this. Okay, great. Your portal to your healthcare patients is a little outdated. We can clean that up. That's important. And add functionality that automates things so they're not calling in. So it reduces your call center. That kind of activity is still going on. Because, technology is a vital piece of every organization, period.
Yeah. And you bring up an interesting point or question that jogs that's triggered in my head is, when you're looking at buyers and you're bringing buyers to the table, is there a strong preference towards sort of the recurring revenue model of a SaaS technology provider versus a services provider that doesn't necessarily have that sort of lock-in predictable revenue?
Yeah. I mean, they're definitely different. I mean, services businesses generally trade on EBITDA, because they're not growing 40%. It would be pretty difficult. And they're nice and profitable. When we have a service, so we closed a company's called 40AU in Nashville, outsourced software development shop, that we closed a recap with private equity shop in Atlanta back in November. And that is a fast growing, nicely profitable business that doesn't have contracted recurring, typical SaaS type revenue. But we built the story of, hey, this is how we've grown, and this is how we can replicate how we've grown. And the land and expand, right? We got into this hospital system, and then got to know this person, and that's what we've done. And by the way, here are 5 case studies of how we've done that. We've mastered that. And so I think that's a pretty attractive, where you take services and show them as reoccurring, right? With you create relationships. Maybe you've done a bunch with a Toyota plant, and there are 15 other Toyota plants, and it's just a matter of time before you help, roll something out. Or so we look at the recurring and the expansion, right? How else can you grow? But yeah, you're not a software company that's growing 40% is going to get a revenue multiple, and also the value that you're providing. So back to your profitability, a services company that's 10 million and 1 million and growing 5% a year, right? That depending on what they're doing, that could be 6 to 8 times EBITDA. If they're growing 25% a year, or they're 25 or 30% EBITDA margin, there's something special about that business model. You're going to be looking at 8 to 10. And then if you add a vertical that you're really good in, you're really good in energy or hospital, or, you've really refined and have a stranglehold on that industry from a services perspective, maybe you're 10 to 12 times. Right. And then if you add any recurring into there, you might get a little boost from that as well. But those services businesses were trading at crazy multiples coming out of COVID. And they've come down a bit. And again, not unlike the software companies, how are your customers performing? Right. Are they going to cut backs, or it is a repaint kind of economy, but are they going to cut all projects? Right. As in for cost cutting and battening up the hatches and that sort of thing.
Yeah. There's just so much. Whenever there's uncertainty, and there's competition for those investment dollars. Like now we hear a lot of clients that are saying, well, we're going to kind of hold off and see, or we're real slow making a decision on whether or not we want to move forward with the big technology initiatives because we're not sure how tariffs are going to affect us, for the North American clients we work with. Just as one example. But anytime there's uncertainty like that, it seems like that creates that can disrupt the predictability of some of these revenue models, especially on the services side.
Yeah, that's a good point.
Yeah, real interesting. Now I know this is a little bit outside of what you normally do. I mean, you're not dealing with CIOs and CFOs at companies that are buyers of enterprise tech in the same way we do. But if you were a CIO or a CFO at, say, a big manufacturing company, a global manufacturing company, you were looking at investing in or partnering with a potential technology or a technology services provider that wasn't one of those big names that everyone knows and everyone feels kind of comfortable with, because there are a lot of upstarts, a lot of startups, a lot of high growth companies on the services and the software side. What are some of the things you'd be looking at in terms of viability and just the overall health of an organization, not from an investor perspective, but more from a potential customer perspective?
Okay. I think it's always the case study reference, right? Talking to people who've worked with that person I'm considering coming in and doing a project or buy, right? I think you have to talk to people about their experience, because you're right. The brand names get in generally because of the brand name. But can also fail, right, on implementation and delivery of what they, doing what they said they would do. So, no, I would talk to other people. It's hard for a startup in that, infancy of 1, 2, 3 million in revenue, services wise, to kind of continue to grow, because people can be concerned. Are you going to be here tomorrow? Are you hiring? Are you firing? Are you retaining people? What's the culture, right? Are you around? Right. And I think that's going to be really important. And then I imagine, you tell me, but your bill rates and who's the team. I mean, I imagine it comes down to who are those people that I'm going to be working with on a daily basis.
Yeah. Cultural fit, does it fit our team? Is it someone that has the right balance of flexibility versus repeatable standard processes and approaches?
Right.
And then on the software side too, there's something to be said for working with a smaller and scrappier, hungrier software company versus one of the big guys that own or control all the leverage in the relationship. If you've got, we work with a couple of partners of ours, because we're moving down that path of tech-enabled services, and we partner with and we license technology from different providers. And some of these smaller ones they're scrappy. I mean, they want to work with you. They're hungry. And there's something to be said for that versus like if we were to go work with a you mentioned NetSuite or, looking at Oracle or an SAP, they probably don't give a crap if you are concerned about the T's and C's in their contract. That's not that's our problem, not theirs. And so, but working with a smaller company, it's not just about leverage, but it's also just about who's going to give you the attention you need, and are you going to be important to that, or how important are you going to be to that potential partner? So I think those are all good points that you make there. What about for investors and founders that are running either a technology, software, or services company? What are some of the realistic expectations you could set for us around valuations and exits in this current climate? So if we want to go out and find a buyer or investor right now, where do you see expectations being off base most often? I guess maybe is a good way to put it. What are some of the expectation setting things you might suggest to us here today?
Yeah. So the first comment I would make is that the interesting dichotomy of the last 2.5 years being really slow and is that private equity still and VC has a lot of money, right? The dry powder that we all talk about, and is desperate for deals.
Right.
What's interesting is that a lot of private equity and tech M&A did deals from 2018, 19, 20, 21, 22 at some pretty big multiples, and now have holding in a business that's probably worth less than what they paid for it. So they don't want to transact. At the same time, you have limited partners who are in your funds there that want you to sell those businesses so that they can get capital to commit to your new fund, which is investing at a much lower valuation environment.
Right.
So private equity, a lot of the last few years deals have been private equity to private equity, no banker involved, no auction process, just these two people know each other. Maybe they competed for an asset, somebody lost, somebody owns it, now goes to that person and says, hey, I'd like to get some liquidity to my limited partners. And so I know you like this business. Do you want to buy 40 or 50% of it? And I'll still keep a meaningful role, but that'll get me some capital to people. So deals are still happening, and investors really want to look at deals. I think if you put your investor hat on in an environment like this, you want to do deals, but you really want to reduce your risk, right? Because nobody wants to do a deal in a weird topsy-turvy market and have it not work out well, because it's really easy to say, what were you thinking, right?
Right.
I mean, Trump, tariffs, right? So investors are a strong kind of risk off mentality right now, but they want to do deals. And that's why those A+ deals, right, that are super clean, that are growing, that are profitable, you feel more comfortable, and you have to overpay, quite frankly. I mean, those are, double-digit revenue ARR type multiples.
Right.
So that's the environment that we're in. If you're, again, because there has been this dearth of B+, A-, kind of that middle chunk companies coming to market, I do think we're going to see more of those, and I think that will jumpstart some M&A as well. So multiples wise, it's like I said, if it's services, it's an EBITDA multiple. If it's a product, it's based on revenue generally, unless you're only growing 5 or 10%, in which case people will look at your profitability, because it's just an investment for cash flow at that point versus the meteoric growth. So, but look, if you had a neighbor that sold their business in 2021 or 22, I would stop talking to them, over beers about the multiple that they got. And nobody gave their business away, right? That's the other story. Anytime you hear from it, it was this incredible multiple and easy, and they loved my business. And those multiples are going to be hard to come by, quite frankly. I mean, selling the 5 to 10 ARR business at a 10 to 12 multiple doesn't happen anymore, right? I mean, it just doesn't. So, but everything is kind of shifted out. But you know what? When I say we're back to the 2018, 2019 multiples, those were fantastic multiples.
Right. It's just all relevant. Right.
It's so unfair to shake a stick pre-COVID, because they were really, they were 15 to 25 times EBITDA type multiples for software companies. right?
Right.
And 8 to 10 times revenue. So I think with perspective, it's still the higher valuations in general, industry wise, go to tech companies, right? And people can take comfort in that. And they're valuable businesses for a lot of key reasons.
Yeah.
So did that answer it? I mean, I think it's
Yeah.
still a good time to go out there. I think if you are small or not profitable or not growing, it's a really rough market out there to try and get a deal done. Buyers are afraid of doing things. A lot of buyers have moved up. They don't want to see smaller deals. It's rough out there. Again, that's a risky asset, and this is not a risk on kind of environment.
Right. They're a little more risk adverse right now
That's
as
right.
investors. It's funny that you're talking about the good old days of 2021 and 2022. That shows you how fast this is all changing, right? And how fast it
Right.
could change back to the days of 2018 and 19.
Right.
Um,
That's right.
I want to get to this really interesting question on LinkedIn. This is from Jeremy on LinkedIn. Jeremy says, how do you assess the ability of a target investment company to flex, change, or pivot to market changes? Is that a metric that influences the multiple? So in other words, maybe the overall agility and ability to change and adapt. Is that something that buyers look at or that you look at as far as, especially in uncertain markets and uncertain times like we're in right now? I would imagine there's some value in that in terms of a company's ability to pivot and change course based on what's happening in the world. First of all, is that important? Second of all, if it is, how do you buyers, or do they value that in some tangible way?
Yeah, I mean, I would think that, so working backward, I would think they would value that because again, it'll come out in the financials, right?
Mm.
You're able to pivot like that to avoid something or take advantage of something, or it should be reflected in the profitability or the revenue growth, or so I'm not sure they ascribe a certain um, piece to that, a multiple, a half turn multiple to that, but I do think it comes out. I think the other thing that they would probably ask is, it's great to pivot, but how expensive is it, and what are you doing in that pivot? And it's hard because we're kind of shadow boxing in the hypothetical, but
Right.
as long as there's not a big capital investment to move over here again, because things change daily, right? You need to be careful about what kind of commitment, what that flex, change, pivot is, and what's involved, because things could change, right? It's a mercurial administration at the moment. And so as long as there's not a big capital investment involved in that pivot, being able to move like that, to me, being able to pivot like that is a sign of a good business owner, right? We talked when the interest rates just started to go up and things slowed down, the whole idea of business unit economics. Right? We were all just growing at all costs, but did people understand when we sold a unit of something? Did we make money? Or
Right.
so it's the same thing here, right? It's just good business to be able to do the analysis and do the work and be able to pivot and illustrate that to an investor.
Yeah. Yeah. Super interesting. Yeah, and that's I would imagine in today's day and age that's more important than ever. But anytime really, because like you said, you talk about risk. A investor is not real, or investors in general are not real interested in risky assets or risky investments right now. So I imagine that's one of those things that could help make a target more appealing, is if they can adjust and they can mitigate some of that risk of uncertainty by being able to adapt faster than other companies that are out there potentially.
Yeah. That's the other thing for your audience, as if they're considering selling, or, and it's very hard to do, but get outside of the business and try to look at it objectively, which again, really hard to do. But try to look at your business from the outside to try to determine what's an outsider going to see, right? Yeah. Are they going to see, we often use this one, are they going to see, because you're at 7 million in ARR, your salesperson is one person who, she's wicked talented and drives everything, and that's awesome. Of course it's awesome, it got you to 7 in ARR. But is an investor going to look at that and say, well, what if she leaves? Number one. Number two, are we building this for the future? Do we have systems? Are we recruiting? Are we training? Are we promoting? Right? Or is somebody going to look at that and say, what you thought was a huge advantage is actually potentially an area of concern,
Mm.
right? Because so being able to look at how do we keep our books? Are we cash? Well, people want accrual accounting, right? So you ought to look at that and figure that out, because if you're a business like a lot of software businesses that get a bunch of deferred revenue upfront cash wise, it'll give you that inflated, wow, look at the balance sheet. But that's not accrual,
Right, right.
right? So you live by it cash wise, which is great, but you need to see that nice recurring revenue deferred uh, trickle down over time. That's the beauty of your business. Frankly, you should track it that way. So,
Yeah.
and I think the other thing, back to SaaS or on the services side, utilization and bill rates, and a lot of people just kind of assume they're at certain rates, right? Oh, we're 110 net dollar retention, or we're 95 gross, because that's what they've been told. But somebody needs to do that. The buyers are going to do that analysis. They're going to get the core data. They're going to analyze it. They're going to come up with a number, and it better match, right? Or you've just been kind of living this, not lie, but telling yourself it's 110 when it's really 97, is different, right? And you should, if you take that step outside your business and look at it, is pipeline growing? Are we building backlog? Investors aren't stupid. They're going to look at all this stuff too. And maybe there's some things you can change. Maybe bill rates have been flat for a quarter over quarter, and you need to start changing some things. And so anyway, that was a tangent, but that's just for what people might do if they're thinking about a deal.
Yeah. Well, speaking of thinking about doing deals and getting your crystal ball out and predicting the future, if we're to look ahead 3 to 5 years, what are some of the biggest shifts you expect to see in the tech startup and the overall merger and acquisition ecosystem? How do you think this is all going to unfold here in the next 3 or 5 years?
Boy, that's a tough one too.
General trends, or I mean,
Yeah.
it seems like every time I talk to you, it seems like the landscape has changed for better or for worse pretty significantly. I mean, it seems like there's sort of tectonic shifts in the market that, some are anticipated, some aren't. Things like interest rates, it seems like you can kind of see that coming when
Right.
interest rates affect, people's willingness to invest or not. But then there's other things like tariffs that, you may not have expected to happen the way it did, and or impact the M&A market the way it did. But I mean, just based on what you're seeing, feeling, hearing, what historically, what do you think is going to happen just at a high level? What trends can we expect in the next few years?
Yeah, it's interesting to think, given how crazy it is tariffs wise and interest rates and Jerome Powell and Trump. And I actually think the reason I'm having a difficult time laying out 3 to 5 years from now is AI, right? And the impact that AI has on everything. But and it's positive and negative, right? So AI on services. So for outsourced software developers, maybe that first pass of code can be AI'd, right? So we don't need those people. Well, what does that do to our promotion of people within our industry, right? So it's good because you're reducing costs, but then how does that influence my business and how I grow the business? Because I need people who have done it, who have evolved through the ranks to lead the junior people. Well, if I replace those junior people, how do I grow that business? AI in software companies. I mean, I don't think we ever get to this point, but are you going to be able to just go to AI and say, hey, I've got this warehouse management company or implementation, and I want this data and this data and this data to be pulled out every month and uploaded into this KPI report. And does it do that? Right. And are people comfortable that a machine has created that function and that it's going to do it correctly? And, has it been done properly? And so I think AI is just a really interesting impact. It does feel like it reduces jobs. I think people can use advanced AI, the Copilot, the where you're paying for it, not just Chat GPT. Right. To run marketing campaigns and come up with its own cadence of pinging certain people. Maybe it can also go out and find people that you hadn't found and their emails and is just marketing your product to them, and maybe they buy your product. And that's a pretty wild scenario. But I think that could happen. So that makes me a little nervous. It's hard to tell. I think technology and automation, there's still a lot of things that need to be automated, right? So in that gives me optimism that there are still pain points. There are still inefficient ways of doing things. There are business processes that people have just grown used to and accustomed to, even though they're terrible, that can be fixed. So I'm still an optimist from a technology standpoint. I just think it will be produced and delivered in ways that we might not fully understand today, right? That it's just because AI is so exponent. It's like who was the Intel chairman? Was it Grove?
Andrew.
Or no, it was Moore, Gordon Moore. The Moore's law, right? The exponential increase of computing power. The AI is that on steroids, right? I mean, it's really wild to see. So I think interest rate. A lot of the world is capitalist, and people want things to calm down and get back to doing deals and low rates and expansion and growth. And if we all need that, I think generally that works over the next 3 to 5 years. We're going to have some speed bumps, obviously. But no, it's AI that's still, I don't fully understand the impact on my client base. And I don't think my clients understand it yet either. Everyone's dipping a toe and using it in certain ways.
Yeah.
But we'll see. I mean, you tell me, what do you think about the next 3 to 5 years?
Yeah, as far as technology in general, I mean, I couldn't necessarily speak to the M&A space and how investments will pan out, but just in general, I think AI is creating uncertainty. Like you said, there's just so much uncertainty of what it means. How is it going to affect our business? And we're seeing more and more clients that are saying, hey, can you help us define an AI strategy and define a roadmap for how we might deploy it? In fact, I'll give you a shameless plug here for the audience. If you're interested in our guide to AI strategy and implementation, I've put up a QR code here on the top left of your screen. You can download that. It has a lot of trends in the AI space that you can learn from. We also talk about how to define a strategy and a roadmap for your usage of AI. But I'll leave that up for the audience to scan. But in the meantime, to answer your question, I think that organizations what we advise our clients to do is sort of take a step back. Don't ignore AI by any means. I mean, use AI selectively and where there's high value opportunities to use it, but don't feel like you have to go all in on AI right now and have it maybe under invest in other areas that you should be investing in. For example, a lot of companies have crappy old legacy systems with crappy data, and so if you're going to be using AI at some point in the future, which we all will be, if you're not already, you will be at some point soon, you can start cleaning up your data. You can start getting your back office systems in place or get your ducks in a row to where you can start using AI if and when the time comes where there's the maturity or the understanding of how you're going to use it. So that's generally speaking, I think, where we're headed. And I think a lot of organizations still have to run their business. They still have to automate. They still have to invest in technology. They still have to keep up with, the whole SaaS and cloud movement. So many clients are still on-prem, they still haven't shifted to the cloud. So forget AI for a minute. They can't even, get their old AS400 or iSeries system out of the way to be able to move to a more modern technology. So there's a lot of stuff you can be doing and should be doing in the meantime, even if you don't want to be on the bleeding edge of technology, which most of our clients don't want to be. I mean, most of our clients are pretty, risk adverse, third generation family owned businesses or high growth PE owned firms that aren't necessarily looking to, change the world with AI per se. They're looking to produce a better widget, or, they're looking to scale their operations or whatever. So yeah, interesting stuff for sure. Well, I appreciate you being here today, Adam. This is really interesting. How can people, what are the best ways to connect with you, to learn more about GLC advisors, all that good stuff?
So first of all, it looks like the QR code is not getting people to where you want them to go.
Thank you for that. I did not see that in the chat. I will drop it in the chat. If you go to thirdstage-consulting.com, I'll put up another, while you're talking about how to get in touch with you, I'll put up a new QR code here.
Okay, super. Yeah, I'm just through the website. I assume my email's on the glcadvisors.com. We're in Denver. And have been doing tech deals for 30 years now, which is pretty wild.
That's crazy.
But yeah, easy to find me.
Yep. And I remember you started the company. It seems so new, and it doesn't seem like that long ago. So interesting for sure. But I appreciate you being here today. I'm going to stall for a second so I can put up this QR code here. Guide to AI. And there we go. All right, we'll try this again. I dropped it in the chat for YouTube and some of the other outlets. I couldn't do it on LinkedIn, but I'll include it in the chat after the fact on the replay. But if you scan this new QR code that you see on the screen, that one should work for you. And if not, I'll include a link below. So, well, thanks for being here, Adam. Really appreciate you being here. It was a great conversation. Good to catch up with you as always. I learn a lot from you every time I chat with you. We try to meet a couple times a year just to keep up with stuff, and it's always a good learning experience. So be sure to follow Adam and GLC Advisors on LinkedIn. Connect with them there, and hope to have you back at some point to get another check-in on the pulse of the market at some point in the future.
That would be great. Thanks for having me on, Eric. I appreciate it.
Yeah, you bet. Thanks everyone for your great audience questions too. This podcast will be repurposed. We'll edit it. We'll add some additional content. It'll become part of our weekly Transformation Ground Control podcast. It'll be released next week. Actually, next week's episode, a week from tomorrow on Wednesday, will feature this interview along with additional content that we put out there. So be sure to go to transformationgroundcontrol.com if you'd like to keep up with current and past episodes of the show. We put out new episodes every Wednesday. So thanks for being part of the live production of our podcast by being here today. Hope you all have a great weekend. We'll see you next week, same time, same place. We're here every Tuesday on all the outlets, whatever channel or platform you're watching or listening here today. We'll be on again, same time next week. So have a great week in the meantime, and we will see you all soon. Take care.